Hi, I'm Mal from the Money Study, bringing you another episode of our You and Your Superannuation series. This is up to number 14, and this is all about taking your money from your super and basically looking to put it into an account-based pension for us to retire on and sit back and enjoy our retirement, hopefully. Before we kick off the details, there's my disclaimer. It's all about facts, it's all about figures, information only. This is not advice. Okay, so we retire, and we're talking about being retired over our preservation age, which we've already covered in a previous session. So we've reached our preservation age. For most of us, it's going to be 60, and we've retired. We've got a super account, which we've already decided that we can indeed just leave it in super forever. We do not have to turn it into a pension. We can literally just draw down on our super money as we need it. But any money that stays in super will indeed get taxed like a super account. It will get taxed like a super, irrespective of whether you're 50 or whether you're 90, whether you're working or not. All super accounts get taxed at 15%. When we move it into this thing called an account-based pension, it is indeed 100% totally tax-free. So there's no tax on whatever the fund earns. There's no tax on your pension payments. There's no tax payable on any withdrawals. There's no capital gains tax. We are talking about a 100% total tax-free account. Now, there are caps on this. Currently, the cap is $1.9 million you're allowed to have in pension accounts. And I will be doing a future session on what's called the transfer balance cap. But at the moment, you can have $1.9 million in a pension account, 100% totally tax-free. Now, the idea of the pension account is that it will then pay you a regular income stream for hopefully the rest of your days in retirement. So the government are basically giving you this vehicle to put somewhere to put your money, tax-free. They're trying to encourage you, therefore, to put more money into super, because you can only start a pension, one of these account-based pension, from money that was already in super. So if you're not eligible to put the money into super with the criteria that we talked about in earlier sessions, then no, you can't then create the pension. You've got to have this money in super already to be able to then convert it to a pension. So this is where we've got to do a bit of forward planning. We've got to work out how to get the money into super over time, making sure we get as much as in theory we possibly can, because ideally, what a great place to have our money in retirement. It's 100% totally tax-free. And there's other benefits as well as we go through this thing. See, it can pay you either fortnightly or monthly, or it can pay you half yearly or annually. You could set it up to just pay you once a year as a holiday account if you had other sources of income and so forth. But you get to change it. You can change this any time you like. You can increase the payment. You can decrease the repayment. Now, there is a government minimum, which I'm going to talk about in a minute, but there is no maximum. You could have $500,000 in your pension account and put yourself on a pension of $100,000 a year. Because if you've only got 500, it's not going to last you long, because yes, this thing will run out. You're pulling it out, and it effectively will run out when you've pulled all the money out. But remembering, of course, that this thing is still invested, so it can still grow. But basically, the best part about this is that it's still flexible. It's still flexible in the regard that we can indeed access a lump of money at any time. Okay, so we can effectively, what that boils down to is, we can indeed be on a pension, paying us a regular source of income, tax-free, and then if all of a sudden we need $40,000 to go on a holiday, buy a new car, we can literally fill out a withdrawal form, and we can access that money 100% tax-free. So we can still access lumps of money anytime we like. In fact, we can actually cash the whole lot in. If we've decided that we're on this pension and then, look, no, look, my health is, deteriorated dramatically. I'm just going to take all this money. I'm going to go on a world cruise and perhaps not come back. Then you're certainly entitled to do so. If you've got another opportunity where you believe the money would be better, you can just pull it out. And put it into that investment. You can roll it back into super if that makes sense for some reason or another. And there are things called transitional pensions where you can actually stay at work and create a pension after 60. I will be doing a separate session just on transitional pensions coming up. But this thing is really very, very flexible because I say it's still invested, just like your super account was invested. You get to choose. You get to choose how it's invested, and you can move it from all the investment choices you had before, from risky to safe to conservative to cash. Because just imagine you're in an account and it's earning you, say, 6%, but you are pulling out 6%. You've got $1 million in your account and you're pulling out 6%, $60,000 a year tax-free, which is a bit like an $80,000 income gross. Therefore, it would indeed not, you're not eating into the capital. The account's not even going backwards. It's earning you 6, you're pulling out 6, you still got your money. Still got your money. Of course, if the fund was earning you 7% or 8% while you're only pulling out 4 or 5%, then of course your pension account could indeed still be growing. So just because you're pulling a pension from it doesn't mean that it's going backwards at a great rate of knots. It just comes down to how much you're pulling out compared to what is the thing actually earning you. Now, of course, if poor Aunt Mabel dies, and leaves you $50,000, generally speaking, you can't add money to a pension account. You can add money to a super accumulated account, but you can't add money to a pension account. Once you start a pension, there are no further contributions. You're literally setting it up to pull the money out. Does that mean that that's it? You're stuck and poor Aunt Mabel's money can't get into super? No. Because what you're allowed to do here, we've already said that we can roll it back into super. So why can't we just cancel the pension for 5 minutes, roll it back into super, and if we're still eligible, because we're under 75 to make contributions to super, whether we're working or not, within the thresholds, of course, we could contribute that money into the super account and then 2 seconds later convert it back into a pension account. Now that may sound difficult. It's only paperwork, but quite frankly, if you just rang up the super fund and said, look, I've got some money that I need to add to my pension, they will say, okay, look, we can sort that out for you, and they'll send you the paperwork. But effectively what they're doing is that indeed cancelling the pension, putting it back into super, adding the new money and creating the new pension account. And they could probably do it and even keep your existing pension account number, truth be known. So yes, indeed, we can indeed get money into a pension account using what they call this like a restart facility there. Now, when you die, the full balance or whatever's left in the account, so you add 500, you've spent 100, you're down to 400, the $400,000 total will then go to your nominated beneficiary. So if you don't have a beneficiary, it will go then theoretically to your estate, but it's really similar as a super fund. The trustees would have discretion, so again, you would do a nomination. If you do have a partner, then I would normally suggest that you consider, if it's applicable for you, to create what's called a reversionary pension, meaning that if you die and you've got a partner, your partner would then collect this pension 100%, the same amount that you've been getting. But if they don't want a pension, for whatever reason, they could indeed cash it in. Therefore, they've got the flexibility of having the pension or indeed just having the money. Whereas if you nominate them as a beneficiary, this money would actually be cashed out of super. they would receive it as a lump of money into their bank account, and depending on their age, they may not be able to get the money into super. So therefore, it becomes a bit of an issue. So generally speaking, reversionary pension to your partner effectively gives them a little bit more flexibility there. I talked about the government minimums, and you can see here that if you start a pension under 65, you must take out 4% of the balance. So I said if you had $1 million, you'd have to take out $40,000. If you had only $500,000, you'd have to take out $20,000 as a minimum, but there is no maximum. See, the government have imposed a minimum because, you see, they don't want you to have $1.9 million, which is what you can have in a pension, 100% totally tax-free, and then not spend it. You know, they want you to put this money back into the economy. They don't want you just hanging on to it and then passing it down later on. They want you to spend it. You know, they're giving you all these tax breaks. So effectively, you become this self-funded retiree. Once you get to 65, it then increases to 5%. At 75, it's gone to 6%. And by the time you get to 80, it's 7%. I say we've seen a lot of pension accounts over the last decade or so making 7% quite consistently, and therefore you could see, you know, that you could be 75 or 80 before you even saw this money going backwards. Now, of course, once you get up to 85, we're up to 9%, and 90, 11%, and of course by 95 it's up to 14%. Yeah, they're really making sure here that by the time you keel over, there's not a lot left, and which is, you know, to me, fair enough. Fair enough. You've had this tax advantage of having all this money totally tax-free for all of your retirement age. Those numbers were halved during COVID, and they did do it once before. They limited when things were going not too well, but these are the numbers normally. They don't normally change under normal sort of economic climate, but that's the government minimum. Now, when you take a pension, you can choose just to take the minimum, and so when you tick over these age thresholds, it would automatically change, so you don't have to think about it. If you can select a dollar amount for your pension, so long as it's above the government minimum. Could be a percentage. So obviously, if your percentage was 5%, you have to make sure that you then change it when you tick over that age of 75 and so forth. But once the pension's set up, it's pretty straightforward. It'll just happen. The money would go into your nominated bank account. There is no tax to be considered here. It's still and the other thing when we start talking about Centrelink is the fact that the income is not income for Centrelink age pension assessment. They just still deem it to earn an amount of money, because all you're really doing is you're accessing your own money. So it's not actual income, even though you might be drawing $50,000 from it. It's how much have you got and what is it deemed to earn. Centrelink basically don't look at every single individual account to see what it did earn. They say everybody's account earns the same rate of money. And at the moment, the deeming rate is quite low. We'll talk about deeming later on. But look, effectively, you could find that, yes, even though you've got this account-based pension, you may indeed then be entitled to an age pension, which for many is 67, kicking in to supplement whatever you're doing. Now, of course, if all of a sudden you started a pension at 63, 64 or whatever, you draw enough money to live on, but then at 67, when aged care comes in, age pension, not aged care, age pension kicks in, then you may indeed be able to reduce your money from super, from your pension, your account-based pension, literally because you're now being supplemented from the aged pension. So a little bit of number crunching there as to what you should be pulling out. A lot of people do indeed pull money out faster while they're younger. to literally enjoy the money while they're old enough to enjoy it, or young enough to enjoy it probably. And then as Centrelink kicks in, then we adjust our pension accordingly. Now, don't confuse an account-based pension or sometimes they used to be called an allocated pension or a flexi pension. There's lots of different names for these things, and superannuation income stream are all names for an account-based pension. Don't confuse an annuity with an account-based pension. You'll hear people suggesting you might want to get an annuity. An annuity is completely separate from an account-based pension. An annuity can indeed be purchased from money outside of super. So if you were at least 77 and you had some money and you wanted to create an income stream from it, yes, you could then create an annuity even though you were not eligible to create an account-based pension. Yep, an annuity is an income stream, so it pays you on a regular basis, but effectively what it is, it's guaranteed repayments. So they were basically saying, irrespective of what the share market is doing, see, an account-based pension, your balance is going to go up and down again with the investment returns. Now, you could put it into cash to protect it if you're worried, but of course then it's not earning you as much, and so it goes on. With an annuity, you're basically going to a company that provides an annuity. There's not that many companies out there that will do it, but yes, they certainly are available. And what it does, you give them the money and they say, yep, I want this annuity, and they will give you a quote as to what they will pay based on either your life expectancy or a fixed term, or it may be you and your partner, So irrespective of what the share market is doing, they are taking on the risk. Now, because if they're taking on the risk of guaranteeing you this money, but the share market could fall, then generally speaking, they're not going to give you the same rate, as what the market is giving you. That's for sure. That they are running the risk if the market turns against them, that they over the longer term they're going to be okay. But if anyone wants certainty and saying, okay, I just don't want to have to worry about the share market, an annuity can certainly be something that be quite useful. And the other little thing to take note of in an annuity, it's got one advantage over account-based pensions, is that it's only a portion of the value is included in the assets test for Centrelink. Because the money's locked up and you can't effectively drain it, you can't, because once you've got an annuity, that's it. You effectively, there is no, you can't cash it in, because you're getting this guaranteed money over a fixed period of time. So normally you can't cash them in. And if that's the case, Centrelink take that into consideration. And so therefore, could be someone who's just on the verge of getting Centrelink or not for age pension, might decide to put some money into an annuity, literally because as far as the assets test is concerned, it's treated very, very favourably. They're not quite as useful as they used to be. I remember when I was working as a financial planner in Tassie back in the 70s or so, 80s, that it was a case of, I did a lot of work sort of just to tweak how much money should you have in an account-based pension, how much should you have in an annuity to maximise your age pension. It was just a case of doing these numbers to really try and work out, getting the best of all three. We're here to help you understand what to do with these things, and if you need further help, just book an appointment via our website there. Look forward to you joining us on a future session.